Everyone thinks nations are governed by politicians, by presidents, by prime ministers, by parliaments and cabinets. But what if none of them are in charge of the force actually shaping the destiny of entire countries? What if quietly, invisibly, and without a single vote, cast a global financial algorithm is steering nations toward a state they can never escape, a state of permanent debt, not because leaders planned it, not because corporations demanded it, not because citizens overspent, but because the system, by its design, can't operate any other way. Today, we're going to uncover the silent mechanism that has dictated economic policy, political choices, and national futures for nearly 50 years. A mechanism practically no one sees, yet everyone feels. And the most disturbing part, once you understand how it works, you'll realize the world passed its point of no return decades ago. To understand this algorithm, we need to travel back not to the Great Depression, not to World War II, but to a single decision made in 1971, a decision so small in appearance, yet so seismic in consequence, that it quietly rewrote the financial DNA of the entire planet. Most people know it as the end of the gold standard, but what they don't know is what followed. A transformation in global finance so extreme, so systemic, and so irreversible, that even the people who created it didn't fully understand what they had unleashed. It wasn't a law, it wasn't a treaty, it wasn't a conspiracy. It was an algorithm, a set of feedback loops and incentives that now controls the direction of nations the way gravity controls falling objects, and like gravity, you don't see it. You only see its effects. Spiking global debt, perpetual budget deficits, currency crises, inflation cycles, asset bubbles, central bank interventions, and governments that must borrow more to survive, because not borrowing would destroy them even faster. But this story doesn't begin with modern central banks. It begins with something far more simple, a world that suddenly needed more money than it had ever needed before. The year is 1971. The United States is drowning in costs from the Vietnam War and massive domestic spending. Foreign nations, France especially, lose faith in the dollar and begin demanding gold in exchange. There isn't enough gold to satisfy their claims. So, in a single Sunday television address, President Richard Nixon announces something no one saw coming. The dollar will no longer be convertible into gold. That moment was the birth of the modern financial algorithm, because once the dollar was no longer limited by gold, something unexpected emerged. One, money could now expand infinitely. No gold meant no physical limit. No limit meant money could grow as fast as debt could grow. 2. Debt became the main tool for economic expansion. Governments, corporations, consumers, everyone could take on more debt because the supply of currency could always be increased to support it. 3. The system became self-reinforcing. More borrowing gives more money, created more money gives more economic activity gives more need for borrowing, a positive feedback loop, an algorithm. And over time, this algorithm evolved into something far more powerful than anyone expected. Enter the central banks. In the 1980s and 1990s, the Federal Reserve, Bank of England, European central banks, and later emerging market central banks discovered something remarkable. They could guide entire economies with interest rates. This is where the algorithm gained its steering wheel, because lowering interest rates does three things instantly. 1. It makes borrowing cheaper. 2. It increases spending, investment, and consumption. 3. It inflates asset prices, stocks, real estate, bonds. The result, economic growth appears, almost automatically, and political leaders love automatic growth. But there was a catch, a dangerous one. Whenever the economy slowed, interest rates had to be lowered again, and again, and again, until slowly but inevitably, nations became addicted to cheap debt. Debt became the financial oxygen of the world. And the algorithm locked in its next rule. Every decade requires lower interest rates and more debt than the decade before. Look at the pattern. 1980s, rates fall from 20% gives 10%. 1990s, 10% gives 6% to thousands. 6% gives near 0%. 2010s, 0% gives negative in parts of Europe. 2020s. Global emergency printing on unprecedented scale. This wasn't a mistake. It was the algorithm executing its logic. Because in this system, if debt stops growing, everything collapses. Governments can't fund budgets, markets crash, banks fail, currencies panic, unemployment spikes, and political instability explodes. So every time the system slows down, the algorithm forces the same response: create more debt, print more money, lower the cost of borrowing, repeat. The system survived, but at a cost. Debt became permanent. For decades, economists believed the system could continue indefinitely. Debt didn't matter. Deficits didn't matter. Debt to GDP ratios didn't matter. Money printing didn't matter. Until 2008, the global financial crisis revealed a frightening truth. The world had so much debt that letting markets correct naturally would destroy the entire global economy. So what happened? Governments and central banks broke the glass and pulled the emergency lever. Quantitative easing, money printing on a scale the world had never seen. Not for consumers, not for workers, but to rescue the financial system from its own algorithmic trap. But here's where the twist happens. When central banks created trillions in new money to save the system, the algorithm learned something new. If trouble appears, print money. If more trouble appears, print more. If the system becomes dependent, never stop printing. So instead of resetting, the algorithm sped up. Debt exploded. Asset prices skyrocketed. Inequality surged. Governments became even more reliant on borrowing. And then came 2020, a global shutdown, a health crisis, an economic freeze. The world printed more money in 18 months than in the previous 20 years combined. This wasn't stimulus, it was survival. The algorithm had total control. Now the consequences are no longer academic, they're visible everywhere. 1. Global debt has passed $330 trillion, not million, not billion, trillion, more than 3 times global GDP. This is mathematically unpaid. The world is not expected to repay it, only refinance it forever. 2. Nations spend more on interest than on education or health. Some countries now dedicate over 30% of government revenue to paying interest alone. 3. Inflation is no longer an occasional event. It's becoming a structural feature of the algorithm. Because when money creation becomes self-sustaining, prices must rise to absorb it. For political choices shrink, left, right, conservative, liberal, all governments face the same reality. They must borrow to survive, and then borrow again to pay the interest on what they borrowed. Democracy still exists, but economic policy is boxed in. The algorithm decides the boundaries. 5. The system can't voluntarily reverse. Reducing debt would shrink the money supply. Shrinking the money supply would collapse markets. Collapse would destroy governments. So no nation tries. The only way forward is more. More borrowing, more money, more intervention, more dependency. The algorithm runs the show. Over the last 20 years, economists, politicians, and international institutions attempted 3 grand fixes. All failed. Fix number 1, austerity. Countries like Greece, Italy, Spain, and the UK tried cutting spending and raising taxes to reduce deficits. Result: economic contraction gives less revenue, gives more debt. Fix number 2, rate hikes. Central banks tried to raise interest rates to slow inflation, but high rates make debt far more expensive. Result: governments face exploding interest bills, gives more borrowing. Fix number 3, debt ceilings and fiscal rules. Politicians tried to legislate discipline, but every time a crisis arrives, the rules are suspended. Result: temporary limits gives permanent debt. Every fix fails for the same reason. The algorithm punishes discipline and rewards debt expansion. So even the people trying to save the system are trapped by it. Look at these patterns repeating across the world. Pattern 1. Every major economy now requires debt to grow. US needs $1 of new debt to create 40 cents of GDP. China needs $1 to generate 30 cents. Europe needs $1 to generate only 20 cents. The returns shrink over time. Pattern 2. Crises occur more frequently. 1987, 1988. 1989, 1990, 1991, 1992, 1993, 1994. The gaps between crises get smaller. Pattern 3. The solution is always the same. Lower rates, print money, increase debt, no matter the country, no matter the crisis, no matter the ideology. Pattern 4. Nations cannot exit the algorithm. Japan tried, failed. Europe tried, failed. The US tried in the 1970s. 1990s, and 2018 to 2019. Each attempt triggered recession or market panic. The system rejects change, like a body rejecting a transplanted organ. So what exactly is this algorithm? Let's break it into 3 simple rules. Rule number 1. Debt must grow for the economy to grow, because the money supply relies on credit. Rule number 2. Interest rates must decline over time to support rising debt, or the system collapses under its own weight. Rule number 3. When the system hits a wall, central banks must print money to prevent deflation, defaults, and political instability. Put them together, and you get a self-reinforcing cycle. Debt gives lower rates, gives more debt, gives money printing, gives more debt, and this cycle is no longer controlled by individuals, not by the Fed, not by the IMF, not by governments. It's an emergent property of the system itself, an algorithm running on global financial infrastructure. The trajectory is clear: more debt. Global debt could hit $400 trillion within a decade. More money creation, especially during recessions and emergencies. More inflation cycles. Not hyperinflation but persistent, structural inflation. More political strain. People will blame leaders, parties, and ideologies, but the real driver is the algorithm underneath. More digital finance. Digital currencies will not fix the system, they will accelerate it, because digital money is easier to create, track, and manipulate. The world is not heading toward a debt crisis, it's heading toward a permanent debt operating model. The algorithm's final form. Takeaway number 1. Modern economies cannot function without ever-growing debt. This isn't mismanagement, it's structural. Takeaway number 2. Central banks are not steering the system, they are reacting to it. The algorithm forces their hand. Takeaway number 3. The future will be shaped by the consequences of a system that requires expansion even when expansion is impossible. This is the paradox at the core of modern finance. If nations can no longer reduce debt, if money creation must continue, and if crises now arrive in shorter cycles, then the question isn't, when will the system break? The real question is, what will the system transform into next? Because every algorithm eventually evolves. The only mystery is what it will evolve into, and whether we'll be ready when it does. If you found this breakdown clear and eye-opening, and you want more deep-dive investigations into the hidden mechanics driving the world economy, subscribe, share this video, and leave a comment telling us, what do you think the financial algorithm evolves into next? Thanks for watching. And stay aware, the algorithm accelerates.